This one is the Ashburton Inflation-X, code ASHINF, which provides exposure to the inflation-linked bonds issued by the South African government. So inflation-linked bonds, of course, are those that have an adjusted yield which are tracked or referenced off of the current inflation rates. We'll have to look and see what that is all about. It's a specific index which is put together, and the market value of this one in issue is a little bit less. It's about 390 million rand. So Nerina, just again explain to us who does that and what percentage roughly. I mean, is this a big part of the South African government's bond issuance, the inflation-linked bonds?
Yes, it is. This is also just one of two ETFs that track this.
Okay.
So Ashburton has got one, and New Funds also has one. So
Ashburton, of course, is the RMB.
Absolutely. So don't be confused with just a different name. This is what many people know as the RMB Inflation-X ETF. So still government bonds, but now it's inflation linkers that we're talking about. And the big difference is that the government basically ratchets up or increases the capital value that you've invested with them by inflation every year, and the coupon or the interest that you get paid is then based on that increase, that higher number. So it's a product that actually keeps up with inflation very, very well. So it's still government bonds. So will it be affected by a credit downgrade? Absolutely. Will it stay affected to the same extent? Probably not, for the simple reason that if we get a credit investment downgrade, we will be seeing inflation coming a lot higher because of the rand probably weakening as well.
Right.
So
and
as
we know
the
that a
rand
lot of our
weakens,
inflation comes from weaker imported
from the currency.
inflation.
Exactly. So if the currency weakens, then we'll get a much higher inflation, which means you're going to have significantly better protection in your portfolio by being in inflation-linked bonds rather than ordinary or normal government bonds.
So your argument here would be that if people are committed for one reason or another to being in this kind of sub-asset class, this would be a better vehicle than the previous one.
Absolutely. Or think in terms of things like Regulation 28 compliant funds. Those are pension fund type vehicles, not allowed to have more than 75% of your portfolio in equities. So if you're going to have bond exposure, absolutely inflation linked rather than regular.
But are you hot on it now?
Yes, I am, because I do think that we're in a rising inflation environment, and therefore I do think that this is the time to actually nibble. You don't have to aggressively go into it, but for me this is the mattress in the portfolio, the stabilizer right at the bottom, that when we fall, at least you got something soft to fall on.
Okay, good. The mattress in the portfolio. Nerina's going to go with hot on that one. I think I'm going to go as an equity guy on an avoid in that one.